Hi guys, what's going on? This is Oleg, your real estate broker with Winning Belview Comments. I'm so excited to have this live stream podcast today for you guys, and I have a special guest invite today, amazing person, Jim Murphy, and I will ask Jim to introduce himself.
How you doing, Oleg? Thanks for having me. Jim Murphy with Caliber Home Loans. I've been working there for about 8 years, and we've watched the markets go up and down for a long period of time, and it's been interesting to kind of watch this on the ground level and kind of see a lot of cycles, and I'm excited to chat about it today. So thanks for having me, Oleg. We're going to talk a little bit today just about kind of more of like the history of rate cycles, because I think one thing that people don't realize is the Fed has been in the conversations a lot recently, and Jerome Powell specifically has almost become a celebrity, which is kind of interesting because you've never really heard of Fed chair presidents in the past. Greenspan got a really almost like a hero welcome in the end of the 90s and the 2000s, but typically you don't really hear too much about people who monetize and do bank rates. But now it's so public that I think it's important to look at the history of what rate hikes and what it does to real estate and what recessions really mean in the housing market. Because I think that's a really scary term. So whenever you hear recession, I think people get a little bit fearful. But what we want to do today is kind of show a little bit more historically what we can potentially expect in the future. Obviously, none of us know exactly what's going to happen, but it's something that I think looking in the past, you can kind of get a pretty good idea of the future because history usually repeats itself. And we're seeing that every day. So, Loli, let's move on to the next slide.
Yeah, so like it's interesting. Like we're gonna talk about a lot of cool stuff today: recession, like real estate, mortgage rates, and where this market is going to go. And we're gonna cover like some answers for you guys, but also at the end of this episode, please guys don't be shy to ask questions if you guys watching and with us today. So we will try to answer any questions you have.
Yeah,
And
fire
Jim,
away. I mean, anything you got, we're all in.
yeah. So what is your thoughts about 2022 mortgage rate dynamics?
First of all, I mean, the projections for this year were about half of where they went. I mean, we started this year at, for round numbers, let's call it 3% mortgage rates. If you talk to any economist, Windermere's economist, National Realtor Association economist, Fannie Mae, Freddie Mac, everybody thought rates were probably going to cap in the high 4%, maybe even mid 4%. And that did not happen. What's really interesting right now is how quickly these cycles and how drastic they've been. We basically saw interest rates go from 3% to 6.5% in mid June. That is an amazing turn of events, and we're also seeing things happen on a faster velocity the other direction as well. I mean, we've had a full 1.5% rate drop since just June. Now we've had wild volatility, so we've seen interest rates go up, down, left, right. I mean, it's been kind of wild to track, but the reason why this presentation makes a lot of sense is because 2-3 year rate changes from the Fed and 2-3 year rate changes from the past have literally been happening over the last 12 months. So these cycles are happening much, much quicker than we've seen in the past, which makes us feel like we're going to have a reversal a lot quicker than we've seen in the past too. So obviously inflation has been a huge topic over the last couple of months, but really over the last year maybe, on what we could anticipate when we had so much money go into the markets during COVID over a 2 year span. The Fed rate hikes we've touched on already, but what that really means for mortgage rates, a lot of people really think that when the Fed makes adjustments, that's exactly what happens to mortgage rates, but it's really not true because Fed rate hikes really are more about consumer debt. That really is more like car loans, student loans, credit cards, personal lines of credit, all those things that you borrow from the banks. When the Fed raises rates, that's really impacting your car loans and your personal lines much more than it's impacting mortgages in general, because what inflation does to the return on a bond is it diminishes it. And when your bond diminishes, then you have to increase those prices to match where the inflation data is. So really mortgage rates chase inflation. They don't exactly chase the federal rate hikes. It's almost the reverse. When the Fed raises rates, they try to tame inflation, and when they tame inflation, then mortgage rates should kind of follow that, because a bond is a fixed rate of return. So when the bond
I
starts to
think
get
we have a
closer
slide about
to
that, right? So we should have a
that,
slide about.
yep, there we go.
Yeah.
That's great. So this happened in the 1980s. This is happening right now. And if we look at what happened in the 1980s going into the 90s, inflation went from 7% to 14. Mortgage rates followed inflation and they went up from 12% to 18%. That's a wild jump. The Fed funds rate went from 11 to 20. Inflation went drastically down and mortgage rates followed inflation on the way down. The consequence, though, is we saw a big drop in the S&P 500 and the stock market in general. So we saw that again happen in the early 90s into the 2000s with Greenspan, and we saw inflation go up again. It doubled. We saw mortgage rates go up 1.5%. Then the Fed funds rate went up to tame inflation, and then we saw inflation go down. What happened then to mortgage rates? Mortgage rates went down right with it. The the stock market also took a little bit of a correction on that time period, and that's happening again right now. We went from 1.5% to about 9.6 right now, depending on the marker of inflation that you're using. Like we talked about originally, mortgage rates spiked, and they spiked quickly. These time frames from the 80s and 90s, they took years to move in those directions, but right now they moved, like I said, maybe 2.5 to 3% all the way up to 6.5 in about a 6 month period of time, which is nuts. The Fed funds rate has also matched that. And what this graphic really looks like, and this is kind of hard to look at, but what I want to point out is this time period is basically 3% increase in the Fed funds rate over like a 3 year period of time. The one thing that we have to be really conscious of, and one thing that we don't really know yet, is what happens with the balance sheets and if the Fed does start moving money off the backside. And what I mean by that is they have about $9 trillion in debt. So if they want to start moving money off their balance sheet and alleviating some of that debt, that could have a negative impact on mortgage rates. But this slide shows a 3 year period of Fed rate hikes and moving a little bit money off those balance sheets. Ultimately, when they stopped that runoff, you saw mortgage rates dip drastically. And this is basically 2018 going into 2020 towards the end of this time period. And in 2018, well, like you can touch on this, we saw housing prices get a little bit sideways as well. Right now we've seen a dip, but in 18 that happened at the end of the year as well. With mortgage rates, people forget we're in the fives in 2018 as well. And what we saw going into 19, and this is kind of the end of this graphic, is mortgage rates dropping from 5.25 to about 3.75, 3.8 before we had any COVID interference in the markets at all. And I think we're seeing that same cycle right now. Oleg, you want to talk a little bit about 2018 real
Yeah,
estate market? What
definitely,
that looked like?
because money becomes so affordable and prices for houses it wasn't scary people much at that time, and price increase was pretty dramatic from 2018 to 2022. But again, those prices increase starts probably about 2019, but 2018 we have very similar situations like we do have right now, like almost get to the point when we have 2 months inventory on the market. And
Yeah.
and like a lot of brokers, I speak with a lot of different agents, they thinking about we're probably we're gonna face market corrections in 2018. And it was expecting to get a lot of listings and a lot of properties on the market. But what's happening, what we see in the market, we just when COVID hits, everything's flipped like a coin, like with a few seconds. And houses become desirable and the mortgage rates start climbing down, and mortgages become more affordable for a lot of people who wants to purchase real estate. But at the end of the show, I will show you guys some graphs too about like why people start buying properties, not just as securities, but it's also like as an inflation hedge against inflation. And real estate is a great investment for many people and many investors too, who was thinking and worried about stock market crash or cryptocurrency crash. And so they found real estate. It's a great home for park the money for sometimes, and real estate has become desirable and prices went up so much in 2019, 2020, 2022, all the way to right now. But
Well, and it's
now we're
interesting
coming
too
back
when
to
you,
the same rates like we used to have almost in 2018, right? So, and we have like
yeah, exactly.
5.5%.
Well, and it's interesting too when you see kind of a sideways move in rate and or excuse me, a sideways move in housing appreciation. That's usually the time to enter a market, right? When things aren't skyrocketing, because you're looking at less multiple offers and escalations and contract writing. And what we see on our side is as soon as rates drop, we really see a big spark in people's activity in real estate in general because it's so much more or less expensive. This is another tracker here on the inversion yields. This is something that we track to see what's going to happen on the next potential recession. And anytime you get a better return on a 2-year Treasury note versus a 10-year Treasury note, that means that you're not getting as much for your money in a shorter period of time than a longer period of time. This happened in April of 2022, and currently we're still inverted. So if you're inverted, that usually leads to a recession in 9 to 18 months. And I think right now we're right in the middle of our second negative quarter of GDP. That is technically a recession. So I think we're kind of heading there, or we might even be in it now. So this is the history of inversions over the last basically 40 years. And every single time you can see that little gray bar, that little gray bar was a recession. So you can see the yield curve inversion before that happened all the way back into the 1980s. We saw it again in the 90s. We saw it again in the early 2000s. We saw it in 2008. And now we saw it again in 2020. And this is why I reflect back to 18, 19, 20 so much, because we saw this pattern happening before we had COVID. And COVID basically just put a delay on all this stuff. So now we're seeing it again in April and currently on the yield curve inversions. So usually that will have a recession, and that little gray bar in 2020 was probably like March, April, right when COVID hit. So we had a very mild recession when everybody went home and stayed off of work before government helped all those folks that were off work. So let's pop that next slide. Look.
Okay, let's do it.
This is an interesting one too. So unemployment rate is another big marker, and this is the one that we haven't quite seen yet. But the unemployment rate, if you can see back in 2020, and let's go all the way back to the 60s and 70s and 80s, every time the unemployment rate hits the bottom and starts moving upwards, we hit a recession. And that's what all these darker blue bars look like. These are recessions going all the way back to the 60s. And if you see 2020, we hit a low of about 3.2% unemployment. And we thought, okay, well, if we see a little spike in unemployment, we're going to see a recession in 2020. And now we're seeing it again. We're at about 3.6% unemployment. And now we're starting to get news from, Apple and Google and basically every big company has stated that they're going to pull back a little bit on what their potential future spending was in 23. And as soon as we see that unemployment rate go from 3.6, maybe up to 4 or 4.5, we're going to see recessionary times as well. So all the markers are there right now. But I think so. It's really important.
4.5% will be just enough to get recessions, not 9%, no, not 7% unemployment rate.
If we got to 7 or 9, we'd be in a pretty difficult time. I think it's really more about where the bottom is. When you start to see unemployment tick up at all, then that means that companies are pulling back, and the easiest thing to pull back on is labor. Labor is the quickest thing that you can cut and remove some of the costs to your bottom line. And this is what happens conversely in mortgage rates during those same recessionary periods. We saw that in the 80s. We saw it again in the 90s and the 2000s. You can see what rates do. Every single time we have a recession, rates go down. Going back to, the early mid 80s, we went 18 to 13, then we went from 11 to about 9. And even look what happened in 2020. We went from 375 to 275. Every time we hit a recession, we're going to see a dip in rate. And it's just a matter of time before we see that. We're just not exactly sure. We already saw that happen this year, again, in a very short cycle. We saw rates go from 3 to 6.5 and down to 5, 5.25 over a 6-7 month period of time. And I don't think we've hit the peak of our Fed rate hikes. We really haven't. I saw news yesterday, and the Fed's actually in Jackson Hole at a economic symposium right now talking about what they're going to do in the future. They're talking about 50, 75, maybe 25 basis points in the future, but we should expect 75 or 50 basis point raise in September and probably another 25 in October, November. And by the time we finally level out inflation, we're going to see interest rates come down after that. Historically, that's what the data tells us. Now, of course, again, we don't know exactly what's going to happen, but if we look in the past on these things, mortgage rates really do chase the inflation numbers. And that's what the Fed is trying to make a little bit more palpable for banks and for slowing down the economy, and that's really their only lever right now, and that's what they're doing. So I think we can expect.
Do you have thoughts about like rates probably gonna come down when we're gonna hit recessions really high, and we should expect mortgage rates going down?
I think we've already kind of seen that. When you see
We just see this like for like like was drop like just for like 1 week, right? So about from
Yeah,
5.5 to 4.9% end of July.
yeah. In from June, they were about 6.5, and they went down to about 5.25 over a 45-day period. They have gone up a little bit right now with mostly European inflation fears and worldwide inflation fears. So mortgage rates, when mortgage rates hear inflation, they get scared because
Yeah.
that fixed rate of return will be eroded, and they have to raise a little bit. So they've gone up from about 5.25 to probably high fives, maybe 5.75 or so if we're talking about today, August 25th, 22. And I think that's just because of international inflation fears. But even hearing the Fed talk today about what they're going to do in the future, we had an incredibly positive day in mortgage rates. We're probably down an eighth to a quarter just today based on projected Fed movement. So it really is all about what the Fed's going to do. And I think in the future, I think 23 we'll see rates in the mid fours. I really do, maybe even lower. And I think before we get out of a recession or have a real and a lot of it too is just about what we're going to see with supply chain management and all those cost of goods and what U.S. is going to produce versus they're going to get from out of the country. Once you see those things start to change, then you're going to see you're not going to see interest rates go up on the mortgage side because of the affordability crisis of where house prices have gone. And when you have the median home price go up so much, you have to keep money relatively low, or you're going to see home sales start to maybe drop off even more. And I just don't think we can do that. It doesn't make any sense.
Yeah, but it's kind of like scares me a little bit as a real estate broker because I remember like just a week ago when the rate dropped from 5.5 to 4.9%, we have a lot of buyers move back to the market to buy properties and start going to the open houses. And we see like from 20 to 25 buyers in open house now again. And
Yeah.
interestingly enough is buyers are really sensitive to mortgage rates. And I feel like if mortgage rate is going to be come back to 4.5%, that's going to be generating another wave or buyers power and demand on the housing market. And as we have a pretty short supply right now, so we have like 2 months supply on east side, 1.5 months in Seattle areas. So if buyers going to be come back, we're going to be moved back again to the same craziness of the market like we had like 6 months
100%.
ago.
Yeah,
Yeah.
I couldn't agree with you more. I mean, as
Yeah.
soon as you see mortgage rates go down at all, then, and I think even more than that, it's walking in the door and kind of getting what you're expecting, right? Like if you were a buyer in February and you saw rates at 3.5, and then you go to purchase a house in May and they're at 5.5, that's a huge price shock when you look at what the monthly payments were 4 months prior. But what's been nice about now is we really get people that come in the door and say, okay, we know it's going to be somewhere in the fives. We feel like this market has leveled out a little bit, both on the interest rate side and on the housing side. Now is a good time to buy because things are a little more level. And as soon as you start to see mortgage rates dip, you're going to see a velocity of buyers because you're going to get more for less money, right? It's really simple supply and demand when you look at it that way. It's the same in anything you want to buy. If you can get three for the price of one, you're going to get three, right? And
Yeah.
that's the same thing with housing. And we're going to see that. It's just a matter of, I kind of call it like herd mentality. Is as soon as they feel like it's a good opportunity, then you're going to see more and more and more people follow that lead. And right now, I truly believe it's been the best time to buy a house since the middle of 2018, which again is why I look on that time period so directly.
Yeah, and especially like it's a good time to buy right now for some buyers. It's because a lot of sellers have fears, and fears drives
Yeah,
market as well a lot. So same thing as the fears in the stock market, same fears in the real estate market. If somebody wants to sell the property and in the market for 20, 30, 60 days and the property doesn't sell as they need to sell, they feel like nobody can buy that house. Nobody wants to have it, and those sellers are willing to negotiate, willing to drop price, and buyers have like lifetime opportunity to get this property for much cheaper. Yeah, I just
that's been fun for our buyers. It really
yeah.
has, and it's been so, I don't want to call it refreshing, but it's been so nice to have. We I'll tell a couple of quick stories. I mean, we had someone, I mentioned this in a meeting a couple of days ago, but this client we had was looking for a townhouse in March and April for the same price that she's now looking for a single family house. And anytime that you're not sharing walls, you're going to have a more valuable property. I guess not any time. It of course depends on the property, but traditionally, if you have a single family, it's going to be worth a little bit more than a townhouse. And now she's moved from a different home to a home that she didn't think she could afford. That was only 4 or 5 months ago. And we're now seeing first time buyers using down payment assistance funds and maybe low down payment percentages able to buy homes when in February and March they simply could not compete because the escalations are too crazy and 10, 15% over offers and cash offers all over the place. We just didn't have that opportunity with these with some buyers. And right now, buyers have more power than they've had in I'd say 4 years. I don't know if
Yeah,
you agree with that time frame, but that's what we see.
tot-
It's been really nice.
totally agree. And this is slide of yours. Housing stays strong through recession market, so not through the every recession prices going down like many people I mean hoping for. And I have some clients who's like waiting when the price is gonna go really really down, try to time the market, which is impossible to do, and then they're going to buy the property. But it's big possibilities price is gonna go up again through recession time, and just is only on depends on inventory and demand and supply. So if we're gonna have more demand on the housing market and less supplies, prices can flip to the seller's market again, and will be less homes on the market, and will be more difficult to buy those houses. So we live in a very sensitive market, I can say right now, and very fast moving market as well. And
Well, you
also,
certainly can't
unless
time rate, right? I mean, that's
yeah,
the hardest part. You can buy a house for a certain price, but you cannot time when you're actually going to get that money, right? The interest rates are what the market is, and so is house prices. And the interesting thing to me is, I was looking at something like if you had a $500,000 mortgage loan at 5%. It's almost the same monthly payment as if you had a $600,000 mortgage at 4%. So
yeah,
right now, I think that's what people are kind of forgetting that with these price drops, but with higher cost of money, your monthly payment is the same, and you saved $100,000 on that house buy because you can adjust your mortgage in the future. You cannot adjust your price in the future, and
yeah,
I truly believe we're going to see home sales go down or excuse me, mortgage rates go down, but your home price is not going to go down. Even if you looked at median year over year right now, and this is for the month of July, the median home price across the country, and this isn't Puget Sound, but it was at $440,000. That's an 8% year over year return, and that's after the worst inflation news we've ever had. I mean, that's insane. So if you're just looking at this purely as an investment, that's one way to look at it. But the other way to look at it is you still have to have a place to live. And inflation, the consumer price index numbers, that's rent. Like rent goes up when you have the cost of things going up, right? So
yeah.
the
I can,
landlords right
yeah,
now, especially after 2 years of struggling to maybe get money from tenants because they weren't paying because they didn't have to or didn't want to, and there was no repercussions for that. Landlords are absolutely increasing their rental rates right now.
yeah,
I saw a stat that was about average was 12 to 13% year over year. And it was like 18% on a new lease, and about 3-4%, or excuse me, and about 8-9% on a renewal. So if you think that mortgage rates are high, rental rates are going sky high as well. So that's a huge thing that I think people miss. And the reason why this is not a 2008 housing crisis is because we've got 14 million more households that are able to buy a house right now and 3 million less homes. Like it's absolutely alarming, and that's one thing that I think people kind of forget about 2008. They overbuilt in 2008 based on the demographics that were ready to buy. So if you look at it from that perspective, against supply and demand, if you have more people with less goods, how does the price go down? Like even more than it has. Like that doesn't make a lot of sense either. So it'll be really interesting to see what happens over the next 6 to 8 months. I personally think this window is small, and I think it's probably 4 to 5 months at this point. I think if you wait until next year, you're going to have higher rents and less opportunity to buy something. I really do.
yeah. Warren Buffett says, speaking for investors, it's wise to be fearful when the are greedy, and greedy when the others are fearful. Do you think this
That's
is
right.
like right situation right now about that? I think
It,
that's what people like worries about this a lot. And For a lot of my clients, what I'm advised always to look on real estate not just from perspective like you have to live somewhere. Everybody have to live somewhere. So I have to live somewhere. Jim have to
That's right.
live somewhere. You guys have to live somewhere, and your friends have to live somewhere. So you have to rather own property or you have to buy the property. And so build foundations. That's very very important. When you build right foundations, when you start right, and I have a lot of good stories too. So like I just sold property for one amazing girl. She came from San Francisco. Her family did not have real estate, did not own any real estate, but she young, ambitious, very successful business person, and she's like, I'm gonna start it right. I'm gonna buy property. I wanna own real estate, and like those people like really amaze me because they when they're young, when you like 24, 25, 26, and you starting right, it is the best way to do to own real estate property, because real estate is not just a place to live. Myself, I'm treat real estate as investment. It's the same investment as you invest in a cryptocurrency like bitcoins, the same investments as you invest in a stock market. And if you're making money, you have a job, you have a great income, and inflation about right now 8.5%. If you just keep it those money on a bank, so your money gonna be pretty much dry every year for
You're
8.5%
losing
with
value.
inflations like that. So I mean, it's matter like if you invest somewhere, like and where to invest. If you invest in stock market, I can show you some stock market graphs. Like I'm prepared for this episode, and you guys can see what's happened for with the stock market in couple of years. Let me show you guys just example couple like big companies like Google, Apple. The stock is very volatile, and you guys can see how they drop and down more than 20%. And majority of companies and people who work on the east side, for example, they work for those IT companies. So I did another video about Silicon Valley number two, and what I realized on the 367,000 people who live in between Bellevue, Kirkland, Redmond, and Issaquah, we have about 100,000 IT jobs in this location. So every first person work for IT. So we're basically living in Silicon Valley. A majority of those people who work here, they receiving stocks. They have stocks. They have Microsoft stocks or Google stocks or Amazon stocks, and they have a big, huge stock portfolio, which is very sensitive portfolio to what they do in stock market. And if you guys, thinking to diversify your portfolio, why not real estate? Because real estate doesn't have this big jumps like we have right now here. And real estate, anybody can use leverage if you use mortgage. And you guys know about leverage. What the leverage means is when you put your down payment and amount of increase of your like appreciation of property increase for full amount of property value, so your leverage on your investments much higher than leverage on investments when you just buy stocks with 100% of your money. So I think it's a great deal. And but also I want to ask you, Jim, one more question about. I want to show you based on the Seattle scenario. This is east side. Let me show you guys Seattle area. This is just a second. This is Seattle. Yeah. So a lot of fears we have on the market because for the last 3 months prices went down and went down from $1,019,000 to from April to July $954,000. So prices actually went up year over year for 6%. But
Yeah.
if you just compare year over year, prices went up. But over 3 months, is went down, and this creates a lot of fear from a lot of people. And but when you look on the mortgage side of this flip side, so with increasing interest rate, you guys can see like in December, medium sell price in Seattle was 839,000 and mortgage rate was 3.1%. So if you compare right now to July 2022, for example, and interest rate 5.41% with a medium sell price 954,000. So difference in the mortgage payments $1,783. I understand it's not going to be affordable for many of people, but you don't have to get salary fixed rate, right? So like it's a lot of different programs You can use like adjustable rate mortgage with lower payments and like secure this mortgage and this property just for like what 7 years or 5 years and refinance in the future, right?
Yeah,
What do you think?
absolutely. I mean, there's a lot of creative products out there that make things incredibly affordable. And if you're looking at ARM rates, then like you said, I mean, you're looking at dropping your payment almost, $500-$600 versus some of these other programs. And there's 7-year ARMs, there's interest only stuff, there's all sorts of things that you can look at. And one thing I really want to make a point of too is if you see that drop in price, 18% down to 6% year over year appreciation, it's just like the stock market. The stock market was at 5,200 at its peak, I think, on the S&P, roughly
Mm-hmm.
there. Now it's at 4,200. So a lot of people think it's a great time to enter the stock market because it's down so much. The same with housing. And I think year over year, the Puget's down here at about 6.1% year over year returns on average. And if you're looking at 6% returns on an asset of $1 million, I mean, you're looking at significant gains year over year if you hold the asset for a while. And I think that's the same reason people put money in the stock market is for long-term gains. And there's nothing that replaces the velocity of time. If you own an asset for a longer period of time, especially real estate, that's something that will appreciate at some point because again, we're in a massive housing shortage, both in rentals and in primary ownership. And when you add that in with home builders, they're seeing the same costs go up. So you're not seeing nearly as many permits, you're not seeing nearly as many housing starts, you're not seeing nearly as many completed projects as we were 2-3 years ago. If you add that combination of less new houses being created, more households, and really not a lot of people entering the market right now. I think you're a year down the road, you're looking at a housing shortage of about 4 million units. Because right now we're at about a 3 million unit shortage if you look at the number of people that can actually purchase. So I think right now, again, we're in a weird period where nobody really knows what's happening. But if you look at it very granularly and say, okay, is this an okay time to buy? Do I need a place to live? And what is my long-term investment? I think you have to go off of a historical average and say, all right, if it is only 5 or 6% year-over-year return, that's incredible. Like if you're looking at that asset price. So I think no matter how you look at it, you have to find positivity in a decline in price, especially on the buy side. Maybe if you're a seller and you don't have to sell, maybe it's not the best time to sell your property, but on the buying side, it absolutely is.
Yeah, I'm totally agree with you. So it's amazing stuff, guys. And for those guys who are watching us on YouTube, I'm really suggesting to subscribe to my YouTube channel. And we're going to provide a lot of important data for you in our future episode. And if you guys need to reach to Jim, his information going to be below in the link below under this video. So his information is there. Reach out to him. He will be love to be your mortgage resource as well. And we'll jump into the questions if you see any questions, but I think it's people really shy today. Let me see it. If you have any
Yeah,
questions
and
right
even
now.
and just to jump on that too, Oleg, like just having a conversation doesn't mean anything. Like you're not being there's no cost to do that. There's no fear behind it. If it's a text message or a call or an email, it's a really basic conversation, and it could be anything you want to hear about. Setting up for 2 years down the road. If there's fears about credit, we can work on credit. So, I mean, there's all sorts of ways that we can help you set up for the future too. So it's not something that you have to be fearful about. It's something that we can really try to help position you for the future.
Yeah. Jim, we have our first question is from Tech. He's asking question for you probably will be it is the same interest for jumbo versus conventional loan.
No, it's actually a great question. So right now, usually conventional and jumbo money is about the same, but right now in this time period where jumbo money is basically money that's pulled in from investors. So investors, if they want to get some sort of return in a marketplace that they're not super excited about entering, maybe that's the stock market, whatever it is, they're going to issue money for what they want to return on and what they think that they can get. So jumbo money right now is about 0.75% lower than conventional money. And the jumbo loan starts at a loan amount of $647,200. So it's really interesting to look at the jumbo market right now because banks make money on the interest after the loan has already been purchased or after the house has been purchased and now the loan is serviced. So what happens at that time period is if a loan is actually sold or refinanced in a short period of time, you can't get your return as an investor on that money. So right now, jumbo money is pricing itself well underneath the marketplace to make sure that those loans are serviced for a long enough period of time to get their return on investment. So they're about 0.75% lower right now. Usually, when money's trading consistently, jumbo and conventional is very similar. But right now, jumbo is a lot less.
Yeah, but thank you so much, Jim. That was a good questions. I don't see any more questions today. And we're probably going to be wrap up on this. And guys, please smash like button, subscribe to our YouTube channel, and I hope we're gonna see you next time in the future. And have guys amazing week. Enjoy a couple days of the summer left, and we'll see you soon. Have a good day. Bye now.
Thanks a lot, Oleg. Thanks, everybody.